Welcome to today's Explainer. Look, if you've been keeping an eye on the tech sector lately, you already know that Intel is going through what is arguably one of the most drastic corporate pivots in modern semiconductor history. So today, we're bringing you a comprehensive analyst summary, one that's specifically designed for potential investors, to really break down Intel's strategic turnaround and its current market valuation. We're going to look at the bleeding, the treatment plan, and ultimately, the long-term prognosis for this massive tech giant.
Here is the game plan for today's Explainer. We'll start with the Intel investment paradox, unpack that massive $10 billion cost pivot, and then dive into the 18A foundry strategy. After that, we'll analyze AI computing as their main growth engine, assess the overarching market and macro risks, and finally evaluate the financial forward outlook.
All right, kicking things off with Section 1, the Intel investment paradox. There are some deeply contrasting market signals surrounding Intel right now.
Okay, let's dive into this. 168%. That is literally how much Intel stock rallied in 2023, bouncing back from 52-week lows in this massive vertical climb to trade right around that psychological $110 resistance level. Traders have been watching this momentum closely as investors basically bought into the turnaround story, driven by AI infrastructure demand and, sympathy momentum across the broader semiconductor space, alongside names like NVIDIA and AMD. But as we all know, explosive moves usually bring volatility. Traders are closely watching that $110 to $112 zone above the price as a major resistance cluster, while the $100 area acts as support right below it.
Which brings us to the core financial paradox that's currently defining Intel. On one hand, you have these incredibly heavy gap losses, specifically a recent Q1 gap loss of 73 cents per share. But when you look at the adjusted metrics, you actually see projected non-GAAP liquidity and EPS improvements of 29 cents. Intel's non-GAAP gross margins actually improved year over year to 41%. So the absolutely crucial point here is that investors are having to actively weigh the very real, immediate GAAP cash burn against these underlying operational and non-GAAP liquidity improvements.
Moving right along to Section 2, let's look at how management is actually addressing that cash burn. This is the triage phase, the $10 billion cost pivot.
To stop the rapid depletion of cash flow, management initiated some seriously aggressive cost-cutting measures. They had to resize the company and align their investments with actual market requirements, and the components of this plan are sweeping. First off, they announced a massive headcount reduction of over 15%. Second, they are slashing non-GAAP research and development along with administrative expenses all the way down to roughly $17.5 billion in 2025. Plus, gross capital expenditures are being aggressively reduced by over 20% in 2024 alone, and they expect to generate a full $1 billion in savings from non-variable cost of sales by 2025.
Now you might be wondering, and rightfully so, will a 15% headcount reduction just totally cripple their future R&D capacity? It's a huge concern, right? Slashing operating expenses this drastically always carries the risk of stifling the company's ability to innovate long-term. However, management insists they are maintaining the core investments necessary to execute their strategy. The goal isn't just to arbitrarily hack away at the budget, it's to eliminate what management views as the unwise and excessive spending of the past, focusing purely on efficient, demand-driven manufacturing and technology leadership.
And then there's the really painful part of this triage, the dividend. Intel took the incredibly dramatic step of suspending its dividend entirely to prioritize critical liquidity and build a more resilient balance sheet. Now, while cutting the dividend obviously stings income investors today, management deemed it an absolutely necessary move. They literally had to halt the endless drawdown of cash flow to free up the capital required to actually execute this long-term turnaround strategy.
Okay, so that covers the bleeding. Let's pivot to the treatment plan in Section 3, the 18A foundry strategy.
And this brilliantly illustrates the foundation of that whole plan. Intel completely overhauled its financial reporting to establish a clear structural separation between Intel products and Intel Foundry. By creating this internal foundry relationship, the product side now has to account for market-based manufacturing costs rather than just passively absorbing allocated costs. This transparency is specifically designed to drive cost discipline, boost operational efficiency, and eventually unlock the value of Intel's massive $100 billion in capital assets.
This organizational shift is exactly what supports their wildly ambitious 5 nodes in 4 years journey, a journey that ultimately culminates in the absolutely critical 18A process node. The 18A node is essentially the linchpin supporting their long-term recovery. Following their timeline in July 2024, they released the 1.0 process design kit, which is basically the blueprint for customers to start designing their own chips. By the end of 2024,
18A is slated to be completely manufacturing ready, leading into actual production wafer start volumes in the first half of 2025. This node will then power major upcoming product launches like Panther Lake for client PCs and Clearwater Forest for servers.
Now that we've got the foundation set, let's transition to Section 4, AI computing. This is Intel's primary catalyst for future revenue growth.
Intel is aggressively positioning itself across the entire AI ecosystem, from edge computing all the way to massive data centers. For starters, they're on track to ship over 40 million AI PCs by the end of the year. Their next-generation Lunar Lake CPUs are set to power over 80 new Copilot Plus PCs. Over in the data center space, the highly anticipated launch of their Gaudi 3 AI accelerators is aiming to directly challenge competitors by offering extreme high performance per dollar. Plus, they're seeing surging demand for Xeon CPUs, because as AI workloads shift from foundational model training toward real-time inference and agentic use cases, the need for robust host CPUs in AI data centers is expanding rapidly.
But it's not just about the silicon. It's about a massive cultural shift happening internally. As CEO Pat Gelsinger stated, "Under my leadership, we will build what customers need, when they need it, and earn their trust through consistent execution." This underscores a complete departure from the old "if you build it, they will come" mentality. Intel is moving toward a highly disciplined, customer-centric, and totally demand-driven manufacturing approach.
Of course, no investment analysis is ever complete without playing devil's advocate. So let's jump into Section 5, Assessing Market and Macro Risks.
Now, what's really interesting here is when you impartially weigh the intense internal competitive threats against the broader macroeconomic instability, the picture gets pretty complicated. Competitively, Intel is facing relentless pressure from AMD, ARM, and NVIDIA. Their profitability metrics still lag behind industry averages, and there's massive execution risk in proving that the 18A node and the foundry business as a whole can actually scale reliably and profitably. On the macro side, rising treasury yields and inflation have recently triggered tech sector pullbacks. Furthermore, global supply chain disruptions and geopolitical tensions, particularly concerning the US, China, and Taiwan, loom large over the industry. Though, paradoxically, the US push for technological sovereignty could actually end up benefiting Intel's domestic foundries.
Finally, let's bring this analysis home by looking at management's long-term targets in Section 6, the Financial Forward Outlook.
Let's see how this builds out over the long term. While foundry operating losses are fully expected to peak in 2024, the 2030 financial roadmap to unlock value is incredibly ambitious. Contrast those current GAAP losses against this. For Intel products, they're targeting 60% non-GAAP gross margins and 40% operating margins by the end of the decade. For the newly separated Intel Foundry, they are aiming to hit break-even midway through the decade, ultimately targeting 40% gross margins and 30% operating margins by 2030.
So, what does this all mean? It leaves us with the ultimate question for investors. The stock is currently trading at roughly 8.3 times sales, which is significantly above its historical 3-year average. With that $10 billion triage underway, the dividend suspended for critical liquidity, and the foundry strategy fully set around the 18A node, is Intel a massive bargain, or is it just a value trap? The current valuation suggests the market has already priced in a lot of this turnaround success. So it's really up to you to decide if Intel has truly escaped its potential downward spiral, or if the execution risks are simply too high. Thank you for joining me for this explainer, and keep learning.